not the tax, but the frequency of buybacks, creating market liquidity for an FII, for a retail guy, tax efficiently. Coming to the question of, from a personal tax standpoint, what stands out is certainly the fact that the buyback tax, I personally think it is beyond the point which I'm going to make is a nuanced point and not visible to naked eye. It is not about tax coming down for a retail shareholder alone. If the tax comes down from dividend tax, which was a flat rate, to 12.5% in the tax in the hands of the tax owner, there are two things which happen. One is the frequency with which buybacks were happening had become near zero. Now, when buybacks happen in the market, there's a kind of a market buoyancy which happens. Now, for example, if I'm a listed company, if I'm making profits like if my company's profits projected are 375 crores for this year, and if with God's grace, if I'm able to meet that guidance, the first question which the board will ask is how much to be paid back and by what form. If it is dividend, it does not impact market prices, but if it is buyback, it creates a buoyancy to the price that company is extinguishing their shares by buying it back, increasing the promoter stake if it does not participate. So it is a great positive, buoyant sentiment for the NSE small cap 250 companies, especially because today the balance sheets are reasonably large. And that's why I think is the most important impact, not the tax, but the frequency of buybacks, creating market liquidity for an FII, for a retail guy, tax efficiently.